Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial world. And if you thought our last deep dive was spicy, wait until you see this one, because one company is playing a very interesting M&A game. Today we're looking at Pulmatrix's latest report, and it's a wild ride of corporate strategy shifts and financial numbers that tell a fascinating story, so stick around. First up, let's glance at the balance sheet as of June 30, 2025. Pulmatrix had total assets of about $615 million, down from nearly $10 million at the end of the previous year. Their cash position also dropped significantly from $9.5 million to a little over $5.8 million. This isn't necessarily bad if they're strategically using that cash, but it does show a tightening of their resources. On the liability side, their accounts payable went from $89,000 down to $384,000, and other current liabilities increased slightly. Overall liabilities on June 30th were about $500,000. Now, looking at the stockholders' equity, it paints a clearer picture. The company has a substantial accumulated deficit starting at negative $297 million and growing to negative $300 million. This means they've spent way more than they've earned over their history. However, their additional paid-in capital remains high at over $306 million. This indicates that they've raised a lot of money over time by selling stock, which is common for companies in early development stages. Let's dive into how they've been doing financially. The statement of operations shows revenues were zero for the 3 months ending June 30th, 2025, and also zero for the 6-month period. This is a stark contrast to the $1.5 million in revenue in the same quarter last year, and over $7 million for the 6-month period last year. This massive drop in revenue is primarily because they've completed wind-down activities related to their PRR 900 program, a key part of their past revenue stream. Expenses have also seen a dramatic decrease. Research and development costs fell from $2.8 million in the quarter last year to a mere $14,000 for the same period this year. For the 6-month period, R&D expenses dropped from $6.3 million to just $33,000. This huge cut in R&D spending is directly tied to employee reductions after a transaction with Mankind and a strategic pause on their product development programs to focus on the merger. General and administrative expenses also saw a slight decrease, going from $2 million to the quarter and from $3.6 million to $3.4 million for the 6-month period. These decreases are mainly due to lower employment and operating costs, but were partially offset by costs associated with their merger. It's also worth noting the loss on Mankind transaction, which was $2.6 million last year for both the quarter and the 6-month period, and is now zero. This likely represents costs or write-offs related to that past business event. Something interesting here is the fair value adjustment of warrants, which shows a positive $1,000 adjustment for the quarter and a $67,000 adjustment for the 6-month period. This means the value of some warrants they issued changed positively, impacting their net loss positively. Their net loss for the quarter was about $1.5 million, an improvement from the $5.8 million loss last year. For the 6-month period, the net loss was $3.4 million compared to almost $5 million last year. So while they are still losing money, they are losing it at a slower rate, which is a good sign given the circumstances. Looking at the statement of stockholders' equity, we see the impact of these results on their equity. The accumulated deficit we talked about earlier continues to grow. Dividends aren't being paid, and there's no mention of stock buybacks. The total stockholders' equity at the end of June 2025 was about $5.6 million, down from $8.9 million at the end of 2024. This dip is a direct result of the net losses incurred during the period. Now let's check the cash flow statement to see where the money is actually going. For the 6 months ending June 30th, 2025, the company used $3.7 million in operating activities. This is largely due to their net loss and changes in their working capital like accounts payable and prepaid expenses. Investing activities used no cash this year, which makes sense as they significantly cut down on operations. Last year, they used almost $400,000 for purchasing property and equipment. Overall, their cash position decreased by $3.7 million during the first half of 2025, bringing their total cash and cash equivalents down to $5.8 million. Remember, this is from their starting cash of over $9.5 million at the beginning of the year, so that's a substantial outflow. The notes to the financial statements give us crucial context, particularly about their merger and their business strategy. The big news is the merger agreement with Culligan Inc. They entered into this agreement in November of 2024 and amended it in April 2025. This merger is a major event where Culligan will become a subsidiary of Pulmatrix. Pulmatrix expects to pay a cash dividend to its existing stockholders before the merger closes, based on its net cash exceeding $2.5 million. This part is super important if the merger goes through. The Culligan stockholders are expected to own a massive 96.4% of the combined company. Pulmatrix shareholders will only own about 3.6%. This means it's essentially acquisition of Pulmatrix by Culligan, though structured as a merger. The valuation for Culligan is expected to be around $2 to $80 million, while Pulmatrix is valued at just $10.5 million. This disparity highlights the strategic shift and perhaps a recognition that Pulmatrix is by Culligan, though structured as a merger, the valuation initially hoped. They also mentioned seeking approval from the China Security Regulatory Commission, CSRC, which is a significant hurdle. The closing date was extended to October 12, 2025. Crucially, if the merger happens, the combined company will focus on Culligan's business, and Pulmatrix plans to monetize its intellectual property and clinical assets, including its ISP risk technology. This means Pulmatrix as we know it might cease to exist as an operating entity, and its core technology might be sold off. Such a strategic move often happens when a company isn't finding a clear path to profitability or market success with its current products. They mentioned that if the merger doesn't happen, they have enough cash to operate for about a year, but would need substantial new funding to continue developing their programs. They also indicate that if the strategic review and merger fail, they might pursue a dissolution and liquidation. This is a clear signal of the precariousness of their current situation without the merger. Looking at the breakdown of prepaid expenses, insurance costs went up slightly, while software and hosting costs decreased. In accrued expenses, legal and patent costs saw a significant jump from levels seen at the end of last year. As of June 30th, 2025, there were no liability classified warrants outstanding. They were all revalued and presumably expired or were dealt with. The report also details various warrants that have expired or are still outstanding, many with liability classifications because of redemption features. The company still has stock options outstanding, but the number has decreased slightly. They did grant 0 options in the first half of 2025. Stock-based compensation expense for the quarter was only $6,000 and $14,000 for the 6-month period, down from $103,000 and $301,000 respectively last year. This aligns with the reduced R&D and general administrative activities and staffing. The management discussion section reiterates much of what we've seen in the financials, but adds important strategic context. They explicitly list risks related to the merger not going through, including failure to get stockholder approval and other closing conditions not being met. This merger is not a done deal yet, and its failure would have significant consequences. They acknowledge their history of losses and negative cash flows and the uncertainty of their liquidity. This is a very direct admission of their ongoing financial challenges if the merger doesn't materialize. The company's goal has been to develop inhaled therapies using the iSPAS technology for conditions like migraine and respiratory diseases. However, the report makes it clear they've paused development of these candidates in light of the upcoming merger and are actively exploring monetization of these assets. This means the future of their own product pipeline is uncertain and may be handed off to other companies. They discuss Pure 3100, a potential migraine treatment, knowing its phase 1 results showed good safety and tolerability. However, further development is on hold pending financing or partnership discussions. Similarly, Pure 1800 for COPD treatment has completed preclinical and phase 1b studies showing safety and tolerability, but development is also paused and they are looking to monetize it. For Pure 1900 and antifungal for pulmonary indications, they have a partnership with Supplier outside the US, but have stopped patient enrollment in their US-based phase 2b study. Pulmatrix will receive a small royalty if Cipla is successful. The focus now is on monetizing even this joint venture asset. Their liquidity section states they have enough cash to operate for at least the next 12 months, but this is heavily reliant on the merger happening or other funding sources becoming available. They are very upfront about needing additional capital for any continued development. The cash flow from operations shows them burning through cash faster than they are earning, with a net decrease in cash of nearly $3.7 million for the first half of 2025 alone. It's interesting to note that they state they have no material off-balance sheet arrangements, meaning they're not hiding any significant financial obligations in less visible places. And in terms of controls and procedures, they state their existing controls are effective. The risk factor section is a lengthy list of potential problems, but the key ones revolve around the merger not completing and their ability to secure future funding. This filing also mentions an extension of the merger agreement's term to October 12, 2025, and that they still need CSRC approval. Now for my take on Pulmatrix. This company is in a critical transition period. Their latest filing shows a company that has largely paused its own operational development efforts. The drastic cuts in R&D and G&A spending alongside the zero revenue clearly indicate a pivot. The massive shift in ownership percentages post-merger suggests a sale or absorption into Culgan, where Pulmatrix's future focus will be on leveraging its technology and assets rather than developing them internally. The company has a history of losses. This accumulated deficit is enormous, and while they've raised significant capital through stock sales, the core business hasn't generated enough revenue to sustain itself. They're relying heavily on this merger to provide a path forward. If the merger fails, the risk of liquidation is explicitly mentioned, which paints a stark picture of their options. The key strength of Pulmatrix remains its IS-PERS technology and its portfolio of patents. The opportunity lies in whether they or a new entity can successfully monetize these assets. The major weakness is their ongoing operational losses and the dependence on external factors like the merger approval and future financing. In conclusion, Pulmatrix is in a high-stakes game with this merger. It's a move that could either revitalize the company under new ownership and strategy, or lead to its eventual wind down if the deal falls through. Investors are betting on the success of the merger and the future value of Pulmatrix's intellectual property under its new potential owners. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description, where we have even more in-depth discussions. Thanks for watching. See you next time.